right, welcome back. Now that we understand how the FAFSA works and how financial aid offers are created, let's talk about my favorite part, strategy. This is where we can really make a difference in your bottom line. The most effective financial aid strategies actually happen before you ever fill out the FAFSA. Ideally, planning should start in your student's freshman or sophomore year of high school. But even if you're closer to college now, we still have some options. There are two main areas where strategic planning can significantly impact your aid eligibility: income planning and asset planning. Both are important, but they work differently. Let's start with income planning. Remember that prior year concept we discussed earlier? For students entering college in fall 2025, the FAFSA will look at 2023 income. We call this the base year for financial aid purposes. Major income events during your base year can have a significant impact on your aid eligibility. For example, capital gains from selling investments, a one-time bonus at work, or distributions from retirement accounts can all artificially inflate your income for FAFSA purposes. If it's at all possible, time those significant income events to occur either before or after your base year. Let me give you a real example. I worked with a family who was planning to sell their rental property. By delaying the sale until January of their student's senior year after the base year, they avoided reporting that capital gain on the FAFSA, which increased their grant eligibility by over $8,000 per year. Remember, you'll complete a new FAFSA each year your student is in college, so this planning should ideally continue throughout their college career. Each FAFSA will look at a different tax year. Some specific income strategies to consider: minimize overtime or additional work during base years if possible. Also, avoid retirement distributions during base years if you can. And for business owners, consider deferring income or accelerating business expenses. Also, be strategic about realizing capital gains or losses. And lastly, consider the tax benefits of college savings versus the financial aid impact. Now, let's talk about asset planning. As we mentioned earlier, assets in the student's name are assessed at 20%, while parent assets are assessed at a maximum of 5.64%. This creates some clear planning opportunities. For example, if your student has $10,000 in a savings account in their name, consider moving those funds to a parent-owned account before filing the FAFSA. This simple move could increase aid eligibility by up to $1,436 per year. Remember which assets don't count on the FAFSA: your primary residence, your home, retirement accounts, 401k, 403bs, IRAs, etc., life insurance cash value, small family-owned businesses, and personal possessions like cars and computers. Some families might benefit from using non-retirement savings to pay down debt before filing the FAFSA. For example, if you have $20,000 in savings and $15,000 in credit card debt, paying off that debt reduces your reportable assets without changing your net worth. Now, let's talk specifically about 529 college savings plans. While these are excellent savings vehicles for college, their ownership matters for financial aid purposes. A parent-owned 529 plan is reported as a parent asset, assessed at that maximum 5.64% rate. A student-owned 529 plan is treated the same way, but a 529 plan owned by a grandparent or other relative used to create complications. So there's good news. Recent FAFSA changes mean that distributions from grandparent-owned 529 plans no longer negatively impact financial aid eligibility. This is a huge improvement that opens up new planning opportunities for many families. Now, I need to mention an important caveat to everything we've discussed so far. About 200 schools, mostly private colleges and universities, require an additional financial aid form called the CSS profile. This form is more detailed than the FAFSA and has different rules. So, unlike the FAFSA, the CSS profile has a $25 fee with fee waivers available. It also counts home equity at many schools. It considers business assets differently. It may count retirement assets in some cases. It may look at the non-custodial parent's finances in divorce situations, and has different treatment of grandparent-owned 529 plans. If your student is applying to schools like these, you'll need to consider CSS profile strategies as well. Now, let's talk about special circumstances. The FAFSA provides a snapshot based on tax information that could be nearly 2 years old. If your financial situation has changed, you need to inform schools through a process called professional judgment review. Valid circumstances include a job loss or a reduction in income, a one-time income that inflated your tax return, a divorce or a separation after filing the FAFSA, the death of a parent or a spouse, unusually high medical expenses, support of elderly relatives, or natural disasters affecting your finances. Here's an example of how to request a professional judgment review. Notice it's specific, includes documentation, and clearly explains how circumstances have changed. Every school handles these requests differently, so contact each financial aid office for their specific process. Lastly, don't forget about state-specific aid programs. Every state has different grants and scholarships, many requiring the FAFSA plus additional applications. Let me share a strategic timeline that puts all of this together. So let's say you're in your freshman or sophomore year of high school. Begin researching college costs and financial aid. Focus on your academics for merit scholarship eligibility, and start exploring state and institutional aid programs. In your junior year, understand which tax year will be your base year. Plan accordingly for income and assets, and research institutional aid policies at target schools, and begin scholarship searches. In the fall of your senior year, you're going to complete FAFSA as soon as possible after October 1st. You're going to complete CSS profile if required. You're going to apply for student aid programs and apply for institutional scholarships and continue external scholarship searches. In the spring of your senior year, you're going to compare financial aid offers carefully. You're going to appeal inadequate offers and make a final college decision. Now, let's explore additional funding sources beyond what we've covered so far.